Hey everyone, today we're diving into the world of investing, specifically for you, the young investors. I firmly believe that it's never too early to start building a solid financial foundation. The earlier you start, the more time your money has to grow. Look, I get it. Investing might seem like something only people in suits on Wall Street do, but the truth is, it's the key to unlocking incredible financial freedom, no matter your age. You don't need to be a financial expert to get started. In book, Millennial Money, the author breaks down the steps to building wealth, even when you're starting with very little. It's all about making smart, informed decisions. We'll be covering some of those key ideas today. These principles are designed to be simple, yet effective. We're going to talk about why starting early is crucial and how it can set you up for long-term success, how to navigate the economic challenges ahead, and make the most of market opportunities, and the strategies you need to come out on top, from setting clear financial goals to diversifying your investments. So, whether you're just starting your career or you've been grinding for a few years, there's always room to grow and improve. This video is packed with actionable advice to help you build a brighter financial future. Let's get started. Time is your greatest asset, especially when it comes to investing. The earlier you start, the more time your money has to grow. The magic of compound interest works best when given ample time. The earlier you start, the more time your money has to grow exponentially. Think of it like a snowball rolling downhill. It starts small, but as it picks up snow, it grows bigger and bigger, gaining momentum. This is similar to how compound interest works. That's what compound interest does for your investments. It helps them grow larger over time. Every dollar you invest has the potential to earn interest, and then that interest earns even more interest, and so on. This cycle continues, creating a powerful growth effect. Over time, this creates a snowball effect that can turn small, consistent investments into a significant nest egg. The key is consistency and patience. Let's say you invest $100 every month, earning an average annual return of 8%. This consistent effort can lead to substantial growth. Over 30 years, you would have contributed $36,000 of your own money, but the power of compound interest doesn't stop there. Thanks to compound interest, your investment would have grown to over $150,000. This is the exponential growth we talk about. That's the power of starting early. The earlier you begin, the more time your money has to grow. The longer your money compounds, the more it grows. And the closer you get to achieving your financial goals, time is truly on your side. So, don't wait another day. The sooner you start, the better. Start investing now, even if it's just a small amount. Every little bit counts and adds up over time. Your future self will thank you. The decisions you make today will shape your financial future. Let's face it, millennials are up against some serious economic challenges. We're facing rising public debt, an aging population, and a job market that often feels like a roller coaster with its ups and downs. These factors can make it seem like achieving financial security is a distant dream, almost out of reach. But here's the thing. Burying your head in the sand won't make these problems disappear. Ignoring them only makes it worse. It's more important than ever for millennials to take control of their financial futures, and that starts with investing. Investing is not just about getting rich. It's about building a safety net, a buffer against economic uncertainty and life's unexpected events. It's about having the freedom to pursue your passions, whether that's starting a business, traveling the world, or simply retiring comfortably. The good news is, you don't need to be a financial expert to start investing. There are plenty of resources available to help you get started, from online courses to financial advisors. And even small, consistent investments can make a big difference over time, thanks to the power of compound interest. Remember, the key is to start now and stay invested for the long haul. The earlier you start, the more time your money has to grow. When it comes to investing, diversification is your best friend. Don't put all your eggs in one basket, especially if that basket is limited to your home country. Think about it. The world is a big place, full of opportunities. Investing in stock markets all across the globe allows you to tap into the growth potential of different economies and industries. This strategy, known as global diversification, helps to reduce your overall risk. Think of it like this. If one country's economy is struggling, another might be booming. By spreading your investments across different regions, you're less likely to be wiped out by a single event or economic downturn. Plus, investing globally gives you access to a wider range of companies and industries. You're not just limited to the options available in your home market. This opens up a world of possibilities for growth and can potentially lead to higher returns over the long run. Now, I'm not saying you should throw all caution to the wind and invest in the next crazy fad, but I am saying that it's worth considering investment strategies that diverge from the mainstream. The traditional approach of blindly following the herd can sometimes lead to mediocre returns. To truly maximize your earnings, you need to be willing to think outside the box and explore alternative investment opportunities. This could involve investing in emerging markets, exploring niche sectors, or considering alternative asset classes. Of course, any investment strategy comes with its own set of risks, and unconventional strategies might involve more volatility. That's why it's crucial to do your research, understand the potential risks and rewards, and consider your own risk tolerance before diving in. Remember, the goal is to find investments that align with your financial goals and risk appetite, even if they're not the most popular or well-known. Don't rely on just one single factor when making investment decisions. Instead, adopt a multifaceted approach that combines several good selection criteria. Think of it like building a sturdy house. You wouldn't build a house on just one pillar, would you? You'd want multiple strong pillars to support the entire structure. The same goes for your investment strategy. Consider factors like a company's financial health, its management team, its competitive advantage in the market, and its potential for future growth. By looking at a variety of factors, you can get a more complete picture of an investment's potential. This well-rounded approach helps you make more informed decisions and reduces the risk of making impulsive choices based on incomplete information. Remember, a well-thought-out strategy is essential for long-term success. We're all human, and we all have emotions. But when it comes to investing, letting your emotions drive your decisions can be a recipe for disaster. Fear and greed are powerful motivators, and they can easily lead to impulsive choices that you later regret. That's why it's crucial to take a step back and make data-driven decisions based on facts and analysis, not on your gut feeling or what you heard from a friend. Before you hit that buy or sell button, take the time to research the investment thoroughly, understand the underlying fundamentals, and consider your own financial goals. Remember, investing is not a game of chance. It's about making calculated decisions based on sound logic and evidence. By removing emotions from the equation, you can make more rational choices that are aligned with your long-term financial well-being. Building wealth through investing takes time. It's not a get-rich-quick scheme, and it's definitely not for those seeking instant gratification. The most successful investors understand that investing is a long game, and they're willing to be patient and ride out the inevitable market fluctuations. There will be ups and downs, bull markets and bear markets. But the key is to stay focused on your long-term goals and not get sidetracked by short-term market noise. Remember, time is your ally when it comes to investing. The longer you stay invested, the more time your money has to grow, and the more you benefit from the power of compound interest. So don't get discouraged by short-term setbacks. Stay the course, stay disciplined, and trust in the process. So there you have it, the key ideas from Millennial Money to help young investors like you build a fortune. Remember, it's never too early to start investing, and the sooner you begin, the more time your money has to grow. Embrace global diversification, consider unconventional strategies, and always make data-driven decisions. And most importantly, Be patient. Investing is a marathon, not a sprint. Now, I want to hear from you. What are your biggest takeaways from today's video? What steps are you going to take to start building your own financial future? Let me know in the comments below.